Welcome to the Busted-Arse-Truck-Drivers Economic Insight, delivering you the contradictory elephants in the room.
Big Pen, this here's a rubber duck. We just ain't going to pay no toll. So we crashed the gate doing 98. I says, let them truckers roll.
Apart from the 2% of coins and notes within our money supply, we do agree that that what makes up the other 98% all originates as interest-bearing debt owed to private lending institutions.
No.
No, you don't agree?
No. Not in a nutshell.
Look out, contradiction coming up.
Compared to countries like America and Europe. But I put it to you, we're a small open economy, we have high levels of private sector debt, mum and dad have borrowed that debt effectively from foreigners because their local bankers source that from foreigners. Does New Zealand want to be in a position where it's highly indebted?
Coins and notes within our money supply, we do agree that that what makes up the other 98% all originates as interest-bearing debt owed to private lending institutions.
No.
No, you don't agree?
No.
Look out, contradiction coming up.
Resign.
Honourable Stephen Joyce.
Well, Mr Speaker, on behalf of the Minister of Finance, I thought the honourable member had a better grasp of economics than that. The idea that you could borrow money to invest in the share market and raise money is one of those fallacies that most families decide not to do because they realise that actually if you could borrow your way to success, we'd have done that in this country a long, long time ago.
Look out, contradiction coming up.
We're just at the National Party conference there live at Auckland Sky City Convention Centre. We're waiting for Bill English has just given his speech. He's now going to take some questions from some of the delegates.
Any questions? Yes. Sorry? Who lends who money? Oh, okay. Well, the question was, all these countries that have a lot of debt, who lends them the money? Well, it's not us. We're borrowing. The money comes from, it comes out of the financial markets, so it comes from central banks. They lend money, central banks in Asia are buying our government debt, so we're getting lent money by, maybe the Central Bank of Hong Kong. It comes from these very large pension funds, and I think that's one of the big political issues for Europe and the US, is that the governments are highly indebted, but the money essentially comes from their own workforce. And if they write off the debt, they're cutting the future pensions of that workforce, which is why they work very hard not to write off the debt. But actually the record around the world is that unless you write some off, it's pretty hard to deal with it. Either you write it off or you repay it. So I think the way to think about it is whatever all the mixing and matching through the money markets is, the debt comes from the savings of the wider population. Those wider populations are ageing, they're relying on those savings, and the fact that there's very high debt puts their savings at risk.
Bill English there speaking live at the National Party conference at Sky.
Big Pen, this here's a rubber duck. We just ain't going to pay no toll. So we crashed the gate doing 98. I says, let them truckers roll.
See thee more clearly, love thee more dearly, travel thee more nearly, day by day.
Good morning. I'm still reporting on the economy. For years now, we've heard that Martin Wolf, the chief economics commentator at Britain's prestigious Financial Times, one of the most respected economists in the world, was coming around to monetary reform. Wolf has been named in the top 100 lists of global thinkers by at least 2 magazines and has been an attendee at the prestigious World Economic Forum in Davos since 1999. It is said that he knows all significant central bankers and has their respect. So when Martin Wolf speaks, economists pay attention. The opening sentence of his April 24th piece in the Financial Times says it all. Printing counterfeit banknotes is illegal, but creating private money is not. Attention economists, it's now okay to talk about private money versus state money again. For 100 years now, we have suffered under the delusion deliberately created by the Federal Reserve System that U.S. dollars are created by the government, but they are not. The Fed is not a part of the government. They have admitted it. Federal courts have found it to be true. The truth is that American money is created by private banks every time they make a loan. And then those same banks use that money to buy influence in Congress to ensure that no legislation will ever effectively diminish or expose this racket. That's the truth. What this does is to rob the government of the profit from creating American money. And what that does is to force the government to load Americans with taxes. Of course, it's pretty much the same in every nation on earth. That's why I say that this private money monopoly is the world's leading cause of hunger, poverty, misery, and disease. So what's the solution? According to Wolf, first, the state, not banks, would create all money, just as it creates cash today. The distinction he is drawing here by the use of the word cash is that coin money and even paper money is a very small percentage of the money supply of virtually every nation on earth. It wasn't always this way, but it is today. So the money that today is created by banks out of thin air must be created by we the people for the common good. Remember, that's why bank buildings are always the biggest buildings in every city on this planet, and they do not use these huge and mostly hidden profits to serve the public interest. Step 2, according to Wolf, is banks could only loan money actually invested by customers. Yes, banks should only be able to lend money they actually have. They should not be allowed to create money by simple bookkeeping entries, then relend it out to us at interest. That's where the titanic hidden profits from banking really are. Wolf then lays out his step number 3. The central bank would create new money as needed to promote non-inflationary growth. The profits of money creation are so huge that giving it to a real central bank, one that truly serves the public interest, could eliminate taxation such as income taxes. Wolf goes on to describe the all-important people who would be in control of monetary decisions. Decisions on money creation would, as now, be taken by a committee independent of government. First of all, I disagree with Mr. Wolf here. It may be slightly different in Great Britain, since the Bank of England is wholly owned by the government, but not in the U.S. I would advise Mr. Wolf and the Brits to consider enlarging this committee to make it as broadly representative of the public interest as practical. Remember, it's not what backs the money that's important, it's who controls the quantity. I've seen proposals for this committee being composed of only 9 members, such as a proposal recently floated by Congressman Dennis Kucinich, written by Stephen Zarlinga. Unfortunately, this is dangerously similar to the existing committee inside the Federal Reserve Board, in that it unnecessarily concentrates the money power back into the hands of a few. Small committees will tend to become filled with top bankers, and bankers will never serve the public interest, and soon we'll be right back where we started. As is the case with most British monetary reformers, Wolf leaves open the possibility of maintaining the government's ability to run a national debt. However, I believe that this was the initial trick that got us into the position we are in today. Once government borrows from banks, it becomes subservient to banks. As the Bible puts it, the borrower is servant to the lender. I say, no more national debt. I'm still reporting on...
Look out, contradiction coming up.
real disappointing stuff.
So you get what you pay for in governments, and if you want a different approach, you need a different government. Simple as that.
You don't want to break now? We'll take Peter, eh? Hi, Peter.
Greetings, gentlemen. We've seen our Prime Minister at work subsidising the aluminium smelter to increase electricity prices and get more for the asset sales. The Australian banks have 90% of the market in New Zealand and is about 4.5 billion of profits, about 15-20% of their bottom line. So the New Zealand economy is slaves supporting the Australian economy. Now, Michael Joseph Savage, the party that you are in, used the Reserve Bank to create credit to build infrastructure and houses. And your party, before it left government, changed the local government funding authority. So would you instruct the Reserve Bank, as Michael Joseph Savage did, so people can afford to stay in their houses, especially in Auckland and other places where Auckland spends $1 million a day on interest, to get the Reserve Bank to give debt-free money without interest to local authorities up and down New Zealand to pay for infrastructure?
Well, wouldn't it be great if we could all get free money? I don't think it's not quite. Hang on.
Yes or no?
No.
So
but let me explain what we will do. Firstly, the way the government has gone about subsidising Rio Tinto Zinc and Tiwai Point is pretty dumb. They've just written a $30 million cheque, which just keeps the thing on ice until 2017 and gets them past the sale of Meridian. I think that's a cheap deal. It does nothing for the long-term future of Southland, actually doesn't even help the long-term future of Tiwai Point. You, as a result, you're quite right, are spending 10% more on your power bill than you'd otherwise need to be. Okay, so your second question is whether the government would have a role in credit creation. The government can have a role, but not just by printing money or not by printing money. The role is done by policies through the Reserve Bank that change the amount of money that's being created and the price of money. So either the interest rate or things like reserve asset ratios, leverage ratios that control how much credit is being created. Now, in an extreme situation, governments can print money themselves. It's called quantitative easing. Guess who? The US and the UK are doing a lot of that at the moment. That's why world share markets have been reasonably healthy. There's been enough credit in the system. But they have very, very low interest rates, lower than ours are. And generally, if you want to get things going, you get your interest rates down first, and printing money through credit easing is something that you do later only if you have to. It's not in our current set of policies.
Okay, we'll go to George. Hi, George.
Big Pen, this here's a rubber duck. We just ain't going to pay no toll. So we crashed the gate doing 98. I says, let them truckers roll.